morning, everyone. My name is Aoife Brennan. I'm from Lisney, and what I'm going to do today is just give you a brief overview of the of both commercial and residential property markets. I won't look too much into the future because my colleague James Nugent will do that later on this morning. But what I am going to do is look at our commercial sector, so the office, retail and industrial markets, then briefly look at investment because again James will look at that in a bit more detail, and then finally look at the residential market because I know it is close to all of our hearts. Just firstly starting off with the commercial sector and commercial rents. In Lisney, every quarter, and actually since 1970, we produce commercial rental indices. So we basically take a basket of properties, commercial properties, and we revalue them. So we take into account transactions that might have happened over the quarter and just our own feeling from the market and our involvement, and we value those properties and we track the rents. So I guess like every graph relating to economics or to the property market at the moment, we fell off a cliff at the end of 2007. With rents, we had huge falls in 2008, even more greater falls in 2009, and then into 2010, towards the end, the pace of decline started to ease somewhat, and the same in 2011. And actually in 2011, our overall commercial rents fell by about 6%. And that compares back to 2009 when we had annual declines of about 28%. If we just look at each individual sector, so you see the retail market there, or the retail rents there, retail rents are down about 47% since the peak. Now that's, you know, it's full of variations depending on the type of retail property you're talking about and the location. So for example, high streets around the country have been the worst performing really and have seen the greatest amount of falls. Retail warehousing the same, have seen quite large falls. But again, it varies, you know, with the high streets. You could look at Grafton Street and rents have fallen by about 55% from the peak. Then you could look at Henry Street, you know, only a mile or even less away, and rents there have fallen by about 42%. But when you go into different cities around the country, such as, say, in Limerick, high street rents are down about 75%. In Galway, maybe about 50%. So there's wide variations. I guess one thing to say on retail rents is we're probably pretty close to the bottom for prime product, but we still do have a bit to go for the secondary and more tertiary stock. With the office market, again, quite large falls, down 55% since the peak of the market. In 2009, we actually had massive falls when rents fell about 35% in that year. But last year wasn't so bad, particularly, you know, in prime city areas. In Dublin, we only saw rents fall by about maybe 4%. So, you know, we would be of the view that prime office rents are pretty much close to the bottom in city centre areas. Then just on the industrial market, industrial took a little longer to start falling as rapidly, but we are down about 48% now since the peak, and we probably have a bit more to go in the industrial market because it is a very mixed market and there are a lot of deals being done at quite low levels there. Just, I guess, to say on rents, you know, the falls, it's been pretty much a disaster for landlords, seeing their investment value being eroded away. But from a tenant's point of view, there is excellent value there and there's excellent deals on offer and very flexible deals on offer. But also as well, I guess such a large drop in rents means that Ireland is much more attractive to foreign tenants looking at us, or foreign occupiers thinking of maybe locating here. In Lisney, in conjunction with Worldwide Alliance we have with Cushman and Wakefield, we look at the most expensive retail, office and industrial locations in Ireland, and we then compared with the most expensive office, retail and industrial locations in other areas around the world. So if we look back to 2006, Grafton Street was the most expensive retail location, and it was actually the 5th most expensive retail location in the world, which just seems madness. Since that time we've fallen, and last June we were the 15th most expensive, and it is likely that we'll fall much more this June. If you were to look at the office market, the Dublin 2, Dublin 4 office market is the most expensive office market in Ireland, and we were the 6th most expensive back in 2007. Just there 2 weeks ago we released information on that, and we're now the 26th most expensive. So there has been huge huge gains made in competitiveness there. And if you're to look at industrial, it seems totally mad now, but we were the 3rd most expensive in the world in 2006, and we're now the 16th, but there should be new data released on that later this month, so we would hope to maybe move down a little bit more. Just moving on from the rents and looking at each individual sector, if we look at the retail market, now a lot of this may seem pretty obvious, but what's in and what's out in the retail market at the moment, long leases are gone, guarantees are gone, upwards only rent reviews are gone. So we know after the 28th of February 2010, there's legislation there now that prohibits the upwards only rent reviews in commercial leases. Also premiums are gone. Again, what's in, it's kind of the opposite, and it seems pretty obvious, but short leases are in, and if they're any bit longer, then they will include break options, and they are quite flexible. We have open market reviews, we have inducements, so rent-free periods and contributions towards fit-out to get tenants in. But I guess one of the biggest changes that we've seen over the last few years in Ireland has been the introduction of turnover-related rents. It has been something that, that has been around internationally for a long time, but we have only started to see it in Ireland. So basically, a tenant will pay a certain percentage of their turnover for rent. So if a tenant's business or a retailer's business is doing well, then the landlord will also do well as well. The last thing, just restructuring there, there's lots of different types of restructuring, but some things we've seen could be maybe a landlord and tenant agreeing on restructuring the lease, and if the tenant perhaps moves out a break option or extends their lease, they might get a reduction in rent, but loads of different types. Again, this might seem obvious, but what are the performing sectors? Discount retailers are the best performing sector at the moment. We're seeing a lot of UK operators coming into the Irish market, so the likes of 99p stores who trade as €50 and also Poundland who trade as deals. They're coming in and they're expanding rapidly. We're also seeing local discount retailers such as Eurogiant expanding rapidly, and we would think that such retailers will continue to drive the market in the short term. Also, and probably surprisingly, footwear is doing pretty well, coffee houses are doing well, and jewellery is doing pretty well. On the what's not hot side of it, again, pretty obvious, anything related to households, furniture, electrical, all of those types of goods. And also retailers who have great competition from the internet, so music stores and bookstores. Retail vacancy is something that's pretty hard to track, but we have tried in Lisney to do this, and we're producing now what we call a shutter count. So basically in Dublin and Cork we go around to the prime retail streets and the prime shopping centres, and we have a look and see what units are actually closed. So this is just looking at between Q3 and Q4 last year. What we see is that suburban shopping centres, particularly, this is just Dublin, are actually doing quite well and don't really have that much vacancy. You see Blanchardstown there has 3, but in a shopping centre that has about 130 or 40 units, it's actually not that bad. But a trend which is not just throughout Ireland, it's also a global trend, is that high streets are performing quite poorly. We have quite high vacancy. You can see there on Grafton Street, so at the end of December there were 6 units available, and that doesn't, or 6 units closed, and that doesn't even take account of units whose leases are actually on the market. But it is a problem with our retail high streets that there is quite large vacancy, and I know my colleague James Nugent will talk about it a little bit more later on, but the biggest problem with high streets is the fact that it's in multiple ownership and you don't have one owner to drive the performance of the street, like say with shopping centres. Just moving on to our shopping centre accommodation, and over the last 15 years we went from a nation that was undersupplied with shopping centre space to one that's totally oversupplied with space. And again, we look at this on a worldwide basis, and I think this is just actually on a European basis here with our alliance partner Cushman & Wakefield, and what we can see is that in Ireland we have 367 square metres of shopping centre space per 1,000 population. Now that's the 5th highest in Europe. If we look at the EU average, it's about a third less, and it's only at about 246. So you would have to think that the prospects for shopping centre development over the short to medium term aren't great. There will be little or no shopping centre development, with the exceptions perhaps in prime city centre areas, because actually if you strip out Dublin city centre and look at it by itself, it is actually undershopped with shopping centre space, but it's all the other towns and cities around the country that really boost that figure up. Just to summarise in the retail market then, and where we see the strengths, there's good demand in prime areas, but that is the prime sector of the market, and that demand has been driven by international retailers, and we're seeing a lot of new international retailers coming into the market. There was a story a few weeks ago about Banana Republic looking at Grafton Street, and we've seen Hollister, Abercrombie, all of those guys come in lately. Just on the weaknesses, I guess the older leases that are in place with upwards-only rent reviews are probably the biggest problem a bigger problem for the retail market than the other sectors, and a lot are still paying quite high rents. Another weakness is the poor demand for secondary units, and I guess our consumer confidence. I know Austin looks at that, and while there has been some improvements over the early part or over the first 2 months of this year, consumers are still pretty cautious. Threats then to the market: we are overshopped in many areas. There is going to be increased levels of vacancy in secondary and tertiary areas this year, and we will see further casualties, further retailer casualties. Opportunities then, and I guess this is as it is with every sector, that flexible leases are on offer now and the rents are very low. So there are good deals there for tenants coming in, particularly in the retail market for international retailers. Just on the office sector, now I guess this is probably the good news story of the property market at the moment. 2011 was a pretty good year in terms of take-up. Actually 1.8 million square feet of buildings were either let or sold in the Dublin office market, and that's actually a third more than the year previous. Just over half of that space, I think it was 54%, was in the city centre, which is normal. And also what you can see from this graph here behind me is that the IT sector took the bulk of that space. They took about 38%. But it's interesting to note that Google's purchase of the Montevetro building on Barrow Street actually makes up 11.5% of that. So these stats can be quite skewed by a large building. Just on office vacancy then, it's very spread out. Our overall vacancy rate is about 20%, about 17% in the city centre, up to nearly 38% in the west suburbs, which is very, very high. But just if we focus on the city centre and 17% there, that compares back to 2007 when we were at about 9%, and really for a market to operate efficiently we need about 7 or 8% just so that there can be movement in the market. But it seems very high at 17, but if you actually strip out what we call grade C space, so that's obsolete buildings that will probably never be let again in the future, and if it was actually a better market out there we would demolish them and we would redevelop them. So about 20% of that figure is actually obsolete buildings, so it might not necessarily be as high as you might think. So what that has led to really are some constraints in the office market. So if you are an international an international office occupier and you're coming into Ireland and you want a big building, you want greater than 65,000 square feet or 6,000 square metres, there's actually only 8 buildings there for you to choose from. And in fact, it's probably nearly more like 7 because one of those buildings has a large amount of space already reserved. And given the fact that there are a good number of inquiries out there in the market or requirements in the market at the moment, so we have many that have been mentioned in the press, such as the Central Bank, Salesforce, Davy Stockbrokers, Goodbody Stockbrokers. We estimate that there could be about 1.5 million square feet of requirement out there, which is really a year's take-up. So what we would see happening perhaps towards the end of this year and into next year are actually deals being done for pre-lets. So where an occupier can't find the building they want, so they'll do a deal with the developer to build them the building that they require. Now, these deals won't actually be market deals, they'll be more economic deals. So what I mean by that is that rents will actually be greater than what market rates are at the moment, because they'll need to be to make the building or the development feasible for the developer to carry out. Just to summarise on the office market, Rents are beginning to stabilise, and we believe definitely in Dublin city centre they're at the bottom. It is quite an active market in prime areas, and there are significant requirements out there. Weaknesses, there is reduced demand in some suburban locations, and I guess a weakness, as you have occupiers coming into the market and they see in the city centre you have 17% vacancy. Well, actually it isn't really, because it is skewed by the Grade C space, so there isn't as many options there for them as they might think. On the threats then, there are a lack of large chunks of Grade A space, and there is little new construction. We have no office properties in the pipeline to be completed this year. We actually only had 3 office buildings in Dublin completed last year, which totalled about 11,000 square metres. So that could lead to problems in the short to medium term, because it does take 3 or 4 years for a building to go from start to finish. But this will lead to opportunities. We would see towards the end of this year and into next year there will be opportunities to refurbish some older buildings, and then, as with the retail sector, flexible leases are on offer at low rents with lots of inducements, so break options and rent freeze. So that will entice more occupiers in. Just on the industrial sector then, I guess this probably isn't the shiniest sector of the property market, but 2011 wasn't as good as 2010 for the sector, but there was a good steady level of demand. If we look back to 2010, just to set the scene, the market was driven by large logistics operators, and they were able to get quite large buildings, and they were able to take them on 3 or 4 year leases to reflect the logistics contracts that they had won. So they might have won a contract to distribute certain merchandise for companies for 3 or 4 years, so they were able to take leases for that length. So we saw that throughout 2010 and into 2011, and I have 2 examples up there for you. The first one is a 115,000 square foot building that Eddie Stobart's took in the docks, and the second one is a building that Masterlink took out in Santry. And there are other examples of logistics operators, such as Whitton Canton, who took about 120,000 square feet in Blanchardstown. So they're all quite large buildings. As we moved through 2011, what we actually started to see were a number of smaller occupiers coming back into the market. So you can see there in the first bar that there were 58 transactions of less than 1,000 square metres. So I guess that is positive news, that we might be seeing some more local, maybe entrepreneurial type people coming back into the market at that size. But something that we also saw in 2011, which is maybe a bit more interesting and exciting, are data centres in the market. Now, this isn't something that's new. We've had data centres here, I'm told by my industrial colleagues, since the late 1990s. But there are certain requirements that data centres need. They need what's called dark fibre. Now, that red dotted line was my best drawing of what's called the T50. It might not be exactly accurate there, but it's a dark fibre line that data centres need. And they also need power. They're the 2 key requirements. In a lot of data centres, they will need probably 2 power points coming into their buildings, and also backup generators, so they don't have any downtime. We have seen, we saw in the news that Google are about to open a data centre out in Profile Park in Grange Castle. They bought 11 acres out there. Data Realty Trust also took about 5 acres out there. So it is an interesting sector of the market, and we would perhaps see more of it in the future. Now, I guess the biggest problem for them in the medium term is the availability of power. In Dublin Northwest, there is actually constraints with power, and a lot of the power capacity is actually booked already. So it's really only places out in Clonshock and City West where that is available at the moment. Just to summarise then the strengths, small occupiers are coming back into the market, which is good, and data centres are favouring Ireland, and a lot of that has been down to the IDA attracting them in. Weaknesses, we have very high vacancy. Overall in Dublin it's about 17%, and there are quite a lot of older buildings out there which have added to the vacancy over the last 12 months. Threats then, this is more from an investor's point of view, but with lease lengths getting shorter, it means that industrial is going to be a less attractive asset class for investors. At the moment, it probably only makes up maybe about 10% of the investment market, but with leases getting shorter, it might become less attractive over the coming years. Opportunities, the same with the other two sectors, great flexibility there in leases and rents. But an important opportunity is that of design and build, probably towards the end of this year and into next year. As with the office market, larger buildings are scarce, and what we might find is an occupier can't find the building that they want, so that they will engage with a developer and they will design and get that developer to build the type of industrial unit that they want. But that's really at the larger end of things. That's the occupational end of things. If we just look quickly at the investment market, long-term yields, what I'm just going to show you here is our prime yields in each of the sectors in Dublin over the last 31 years. So what you can see is that retail there, which is the green line, is well above its long-term, its long-term highs, and it's at about 6.85% at the moment. Office is the same, that's at about 7.75 at the moment, and industrial, it's at about 8.85%, and it's not quite at its all-time high, but that's because we had very high industrial yields back in the early 80s. But if you were to look at the long-term averages and where we are in the retail market, we're actually 180 basis points above our long-term average, which is very high. In the office market, we're about 170 basis points above our long-term average, and with industrial, it is less. It's only maybe about 20 basis points above our long-term average. So if we're to look at capital values, and we have looked at rents and we've seen how they have fallen, we've looked at yields and we've seen how they have increased or moved out. So both of those have combined to give us capital values that have fallen greatly. These are IPD figures here. And I guess just to set the scene, if you wanted to look at each sector, okay, the broken blue dotted line there is just an all property. And between 1994 and 2007, all property increased 300%. If you were to look at retail, it actually increased 500% over that period. Office is about 330% and industrial 200%. But since the end of 2007, we have had huge declines, and you can see them just in the brackets there, but all property is down about 65%. The Q4 figures, which were just released a few weeks ago, did show a minor increase. I think it was 0.2% in values, and that was mainly due to the fact that our stamp duty was cut from 6% to 2% in the budget. So it did push up values just slightly, but I think if you take that out, they did actually decline about 3.8%. So it's not quite so positive yet, but we would be of the view, in the second half of this year, those values should start to stable out. But there probably will be a few more falls before that, just due to the vacancy that we have and the shortening of income streams. Just looking at investment turnover, so that's basically the amount of money spent on investment properties in Ireland over the last number of years. And you can see 2006 was our peak year, when we did almost 3 billion in turnover. Last year we only had about, I think, 200 million, so a huge fall off. And what we did see last year, you might be able to just see the blue bar on the top of each of those. The blue bar is the number or the amount that was spent by foreign investors rather than Irish investors. So a big change from other years, particularly over our boom years where foreign investors stayed away from here. In 2011, 80% of the turnover actually came from foreign investors. And that's probably a trend that we will continue to see this year. If we look at, and just to say as well that our 15-year average of turnover is 830 million, and that's probably a sustainable level that we should be looking towards for the future. If we look at 2011 transactions, we had a lot of international players coming in and buying space. What we also had were a lot of special purchasers. Google bought their 2 buildings in Barrow Street, Gordon House and Gasworks House. You had Pennies buying their building. You also had Ericsson out in Clonskee doing a sale and lease back. And we also saw a lot of insolvency processes, the Google buildings, the Pennies building, and also that site which is actually Parkway down in Limerick. That all involved an insolvency process. Just to summarise then on the investment market, the strengths are that we have good international demand there, and James will talk a bit more about that later this morning. And you've seen the yield, so there are excellent returns available. The weaknesses are really the over-rented nature of a lot of properties, particularly retail properties, and a major weakness is our lack of funding. And again, James will talk a bit more about that later. Our threats then, we're going to have a two-tier market for at least 20 years. So you will have buildings which have upwards-only rent reviews, and you will have buildings that don't have upwards-only rent reviews. So we'll have to get to a level where, we'll have probably two prime retail yields, one for buildings that were pre-February 2010 and then ones for post-February 2010. Another problem at the moment is the lack of product that's out there. There is demand, but there's not necessarily the supply of prime product. But we would hope that, that should improve later on this year. And an opportunity as well is the budget measures. So the introduction of a waiver in capital gains tax if you buy an investment property between now and 2013 and hold for 7 years is pretty good news. Finally then, just on residential, we all know the falls that have happened in the residential market, but if I just look at the Dublin market, in Lisney we produce a residential value index, so we would see values down about 63% in the Dublin market, which is probably a bit ahead of what the CSO figures say, but that's where we believe that it is. What we have seen in larger towns and cities is that apartments in larger homes have fallen at a much greater pace, and it's the 3 and 4 bedroom homes that are doing much better. So where are we really now? Well, a problem that we are having is actually a lack of supply or availability of 3 and 4 bed family homes. That picture there just shows the 6-month change in the housing stock. So you might take for example Dublin 14, there are 54% less houses available on the market now than there actually was 6 months ago. Or if you take Dublin 13, Dublin 3, 45% less. So the amount of family homes available on the market is actually diminishing, and it's diminishing rapidly. We would be of the view that in some, well-established areas, so if I was to take Dublin as an example, the likes of Ranelagh, Donnybrook, Milltown, Phibsborough, those type areas, family homes in those areas are probably at the bottom of price falls, just because there is such demand there, and demand from cash purchasers, and also a lot of Irish people who are living overseas who now want to purchase and have a home in Ireland in the future. Now, that's just that sector of the market. With apartments and with larger homes, we're still probably not quite at the bottom, and we are unlikely to see any sort of increases in prices in the short term. But we do believe that there will be a phased recovery, and you will have the established areas, as I said, which will come back first, and that will bring up the other areas, so you will have the more outer areas coming back in the medium term. Just to summarise then, the strengths: good demand for family homes, particularly from cash purchase.